Happy Tuesday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We have some big developments to cover today, but quickly, first, just a piece of housekeeping. I will be in Auckland next week. While there, I would like to do a couple of subscriber meetups, so if you are in or around Auckland, I would love to see you. I would love for you to attend. Please email me at the email address in the description below. Once the event is organized, I will send you the details. I hope to see many of you there. For those who have already sent an email, thank you very much. You'll get those details probably in the next several days. Now, with that said, let's jump in. Then first up, trouble in paradise. China's foreign affairs establishment has been rocked by the reported detention of Liu Jianchao, head of the Communist Party's international department and a seasoned diplomat, once seen as a potential candidate for foreign minister. According to people familiar with the matter cited by the US-based Wall Street Journal and UK-based Reuters, Liu, 61, was taken away by authorities for questioning in early August after returning to Beijing from a trip to Singapore, South Africa, and Algeria. His residence was searched shortly thereafter, though the precise reason for his detention remains unclear. Sources suggest the matter may be linked to national security, though no official explanation has been given. Beijing has not issued any statement on Liu's status. Unsurprising, considering that the foreign minister himself was disappeared only a few years ago, and we still have very limited information on what happened there. A veteran of China's foreign service, Liu previously held senior ambassadorial posts and served as a spokesperson for the Ministry of Foreign Affairs. He also gained prominence as a graft buster in the Central Commission for Discipline Inspection before returning to diplomacy. Since 2022, he has led the International Department, a powerful party organ responsible for ties with foreign political parties and socialist states. Liu had been regarded as a possible, if long-shot, successor to Wang Yi, China's current foreign minister and director of the Office of the Central Commission for Foreign Affairs. Some analysts had speculated Liu could enter the Politburo at the 21st Party Congress in 2027. His reported detention now appears to remove him from that trajectory. The development adds to a sense of instability within China's foreign policy apparatus, which has seen a series of abrupt personnel shifts, that is, purges, and unexplained absences in recent years. With Liu sidelined, it appears increasingly likely that veteran Wang Yi, despite his age, will remain at the helm of China's foreign affairs machinery through the next Party Congress. For now, this typical lack of transparency around Liu's fate reminds us once again of the opacity surrounding elite politics in Beijing, leaving diplomats and observers alike guessing about the deeper causes and implications of his downfall. It remains an unstable and dangerous game at the top. Next up, Chinese tax authorities are intensifying efforts to collect revenue from wealthy citizens trading overseas in a campaign that is forcing investors to rethink their strategies. Tax bureaus in major hubs such as Shanghai, Zhejiang, and Shandong have recently issued online notices and directly contacted individuals, reminding them that offshore investment income is subject to taxation. State media has amplified the message, with the central bank-backed Financial News warning, quote, "There is no exemption for direct stock trading income from overseas. Serious violations will be investigated and penalized," end quote. While gains from onshore accounts are exempt until 2027, offshore trades are now firmly in Beijing's crosshairs. Residents spending 183 days or more annually in mainland China face a 20% levy on global income, broadly in line with international practice, though enforcement has historically been weak. That is changing as Beijing confronts slowing growth, shrinking land sales revenue, and rising fiscal demands, all very familiar to regular China Update viewers, including local government debt, nationwide baby subsidies, and measures to stimulate consumption. The adoption of the OECD's Common Reporting Standard in 2018 has enabled China to exchange financial account information with more than 120 jurisdictions, including Hong Kong. A mobile app launched the same year has further streamlined individual tax reporting. Those tools have made it easier to track Chinese investors using offshore platforms. The cost of identifying and tracking offshore gains has reduced significantly for mainland authorities. Some investors are already being billed. UK-based The Financial Times reports that Shanghai-based Roger Huang said authorities demanded 20% of his profits from trading Hong Kong stocks over the past 3 years and began imposing daily penalties for delayed payments. Others are exploring shifting assets to US-based platforms outside the OECD's framework, betting that Washington and Beijing will not share tax information. This development is just another sign of how cash-strapped and fiscally pressured local governments are turning to whatever options they can to squeeze more cash from the private sector, a move that will do little to fix its structural fiscal concerns. Next up, and staying on the economy, we will look at the stock market. At the heart of China's high savings rate and subdued consumer spending lies a stock market that has long failed to deliver wealth creation. Even after a recent rally, the CSI 300 index is still hovering near levels seen a decade ago, when a dramatic bubble burst, shattering investor confidence. By contrast, a $10,000 investment in the United States S&P 500 over the same period would have more than tripled, while in China it would have gained only about $3,000. For ordinary households, the weak equity market reinforces a culture of thrift. With property prices falling and the social safety net fragmented, families see little alternative but to save, a tendency that complicates Xi Jinping's push to boost domestic consumption and reach Beijing's 5% growth target. Part of the problem is structural. China's stock exchange was set up in the early 1990s as channels for state-owned firms to tap household savings and fund infrastructure, rather than platforms to reward investors. That bias has created a legacy of oversupply, questionable IPO practices, and inadequate protection for minority shareholders. Quote, China's capital market has long been a paradise for financiers and a hell for investors, end quote, said Liu Jipeng, a veteran securities expert. Despite recent reforms, regulators still tilt toward financing needs rather than safeguarding returns. The consequences are evident in the CSI 300's modest gains this year. Even amid global enthusiasm for artificial intelligence, many investors remain wary. Quote, many ordinary people come in thinking they could make money, but the majority end up poorer, end quote, said Chen Long, an asset manager who has been investing since 2014, speaking to US-based Bloomberg this week. He blames both state-owned companies that answer to government priorities and private firms that disregard small investors. Past scandals have deepened the distrust too. Beijing has pledged to stabilize both the housing and stock markets. Regulators have tightened oversight of IPOs, curbed secondary share sales, and encouraged more dividend payouts. Cash dividends from listed firms hit 2.4 trillion yuan in 2024, a 9% rise from the previous year. Progress remains uneven. Share buybacks in China accounted for just 0.2% of market value in 2024, far below the nearly 2% in the United States. Meanwhile, the policy drive to fast-track tech listings risks repeating old mistakes. Regulators have resumed approving unprofitable firms on the Star and Chinex boards, prioritizing capital raising over investor protection. As Hao Hong of Lotus Asset Management put it this week, the only real way to restore confidence may be through a sustained rebound. Until then, China's equity malaise will keep its households saving, not spending, a habit that Beijing desperately wants to change, but so far has been unable to. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of China Update, it's a huge help if you can hit that like button. Subscribing is a big help too if you want to be on top of these updates as they're released. Recently, I've had several comments that they've been unsubscribed to China Update, so if you believe that you should be subscribed, it's worth checking this now. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep China Update financially sustainable. And finally for today, Pakistan has urged the Chinese operator of Gwadar port to step up investment in the surrounding industrial zone, but analysts warn that the business case for further spending is increasingly tenuous as bilateral relations cool and infrastructure gaps persist. At a recent China-Pakistan Economic Corridor (CPAC) joint working group meeting in Islamabad, officials asked China Overseas Port Holdings Company to submit a time-bound plan to accelerate development at Gwadar Port and the adjacent Gwadar Free Zone. The $50 billion CPAC is a flagship element of Beijing's Belt and Road Initiative, with Gwadar envisioned as its linchpin. The port holding company has operated the port and free zone since 2013 under a long-term concession agreement. Yet progress has been sluggish. Pakistan says only the southern portion of the 9.23 square kilometer Gwadar Free Zone has been developed at a cost of $250 million, leaving the larger northern block largely untouched. According to Japanese financial media outlet Nikkei Asia, citing Pakistani officials yesterday, Islamabad argues that the port holding company has failed to attract business and fulfill requirements under the agreement to submit an annually updated 5-year business plan. While China Communications Construction Company drew up a master plan in 2020, no detailed investment strategy has since been delivered. Observers point to shortcomings on both sides. Pakistani officials concede that weak security, power shortages and water scarcity at Gwadar deter investment. Despite a new 10-megawatt power line, faulty transmission has left the port vulnerable to outages. The Prime Minister has ordered a committee to seek permanent fixes, but uncertainty remains. Meanwhile, critics argue that China has also lagged in meeting industrialization commitments. Quote, "The negotiations will be more about politics than economics," end quote, said Hong Zhang, assistant professor at Indiana University. Without adequate infrastructure, she added, the port holding company risks financial losses if it expands. Geopolitics further complicates matters. Pakistan has recently taken steps to ease trade tensions with Washington, prompting speculation that Islamabad may be using Gwadar to pressure Beijing. Ghulam Ali, a Taiwan-based China expert, suggested the move could be a gambit to push China towards disengagement. Pakistani officials, however, deny such motives. To date, the port holding company's direct spending has been limited to $250 million in the free zone, with additional port works funded by the Chinese government. Whether Beijing or its companies are willing to commit more remains uncertain. The Indiana-based expert Zhang warned, quote, "Without a clear business case for Gwadar, further investment is unlikely," end quote. But Gwadar and the Belt and Road Initiative more generally has never really been about the business case, but more about China's foreign policy and geopolitical ambitions. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Unless something big happens, we'll be taking tomorrow off, and the next episode will be on Thursday. So until then, have a good Tuesday, have a productive week, and I will either see you tomorrow or on Thursday.